Shares in Goldman Sachs up a little bit today, but they've had a pretty stellar run over the past year. That U.S. bank posting a beat on profit and revenue in its latest quarter and smaller than expected loan loss provisions. Now, Goldman follows J.P. Morgan, Wells Fargo and Citigroup in reporting double-digit gains in investment banking revenue in the second quarter. We are joined by Chuck Lieberman, co-founder and chief investment officer at Advisors Capital Management. Chuck, thanks very much for coming on the show. Last week, we got some disappointment over net interest margins for some of the U.S. banks, but what jumped out for you with Goldman this morning?
Well, Goldman is less susceptible to net interest margin issues. It's more of an investment banking firm, and the market expects M&A activity to pick up over the course of the year, and their numbers look pretty good in terms of that kind of business. So Goldman's numbers were very good, but more or less expected.
There's been something of an IPO drought, but strong M&A activity. Why is that?
Well, IPOs really depend on the issuer, whether or not they want to come to market. M&A reflects the fact that cash is building up on the balance sheets of a lot of companies. This government is somewhat opposed to mergers and acquisitions. So it's hard to do those kind of deals, but the cash continues to build. And in certain sectors, growth potential is more limited. So that puts more pressure on management to use the cash to do M&A. We see that, for example, in the energy sector. So I think the expectation is reasonable that M&A activity will pick up. And these companies do expect some pushback from the government, but they likely will have to push in that direction anyway.
And I suppose the prospect of the Republicans taking the White House, if that happens, it could increase. It would mean that Washington was less reluctant to approve mergers and takeovers.
Now, that's exactly right. And that might be a factor as well, because before the government gets to view something, a deal could be announced. They could start moving on it, and then there could be a change in government. So by the time the government has to authorize approval, we might be into a new administration. And if the Republicans win, everyone knows that it is likely that approvals will be easier to come by.
I know cable TV is saturated with this topic, but just give us your thought. You think that U.S. President Joe Biden might yet pull out of the race?
Yeah, I do. Obviously, the risk of that has declined in the aftermath of the shooting at President Trump, ex-President Trump. So there's less impetus behind it right now. But my feeling is that every time Biden speaks publicly, he raises the issue potentially again. If he stumbles or it comes across badly, the issue will come roaring back. So I don't think this issue is settled by any means. And I suspect we're going to hear about it plenty between now and the election. Sorry,
just very quickly, why do you think the assassination attempt on Mr. Trump reduces in the short term the likelihood that Biden quits?
Well, I think the Democrat leadership is less inclined to put pressure on him now with the Trump issue in the headlines. So I think it's nothing more than that. The Republicans also get to nominate their candidate, which presumably will be Trump very shortly. The Democratic convention comes up in a few weeks. And from what I understand, there's a technical issue also. If Biden were to pull out, if he does that after he's nominated, then his entire campaign war chest would go over to whoever's the replacement. If it happens before the nomination is completed, then it becomes a trickier legal issue. So it would actually be beneficial for the Democratic Party if Biden can wait until the Democratic convention.
Let's swing back to banks. Obviously, this presidential race is so fascinating. We could talk about it all day. But you think that the big money center banks in the States look like decent value right now?
They look like excellent value. The themes that come through all the reports that we've seen so far, obviously some downward pressure on net interest margins. That's hurting them. but improved business activity pretty much across the rest of the board. There's an expectation that capital markets activity will pick up, especially M&A. And these companies are sitting on more capital than they need. So there will be more stock buybacks, more dividend hikes. They are being cautious because everyone is still nervous about commercial real estate. So they're still adding more to loan loss reserves. But yet the news on that front appears to be perfectly okay. We're not seeing a massive increase in loan losses. So as time passes, the banks are going to be under that much more pressure to do something with their excess cash. And that means more dividend hikes and more buybacks.
We'd better jump. Chuck